so different with the different options. Okay.
John Swaggerty, nice to meet you. Hi, John Swaggerty, nice to meet you. Nice to meet you. Hi, John Swaggerty, nice to meet you. How you doing? Nice to meet you. Hello.
Do you have an envelope with some cash?
The last team stole it.
Clover? Okay, second team, Clover Capital. Clover Capital, you have 10 minutes.
Good afternoon, everyone. My name is Tommy. My team and I from Clover Capital are extremely excited to be here to present our advisory analysis on Lamper Real Estate Investments decision on Mercado de Fuengirola, a retail condo in Madrid. I'll first start off the presentation by giving a little highlight of our investment opportunity and our investment thesis, and I'll hand it off to the rest of my team to talk a little more about analysis that further support our recommendation for our REI. So looking at REI now, they currently already has paid a €5 million deposit on MDF, a 2,400 square meter, 3-story asset located in an up-and-coming retail corridor in Madrid. And the retail complex consists of 50 different tenants, but REI has the opportunity to reposition the asset to a single tenant retail flagship retail space. After conducting thorough analysis and weighing different tenant options, we decided that REI should proceed with the acquisition of MDF and choosing Zara as our top tenant, and with the Decathlon being a viable second choice as well. Now I'm going to pass it off to AJ, who will talk a little more about the economy of Madrid and Spain.
Perfect. Thanks, Tommy. So currently we are in July 2015, where Spain is just beginning to regain its footing after being hit by both the financial crisis and the sovereign debt crisis. The ECB has implemented credit easing programs and brought rates below 0% in order to lift the area and the region out of its recessionary period. Madrid, on the other hand, has been able to weather the storm better than the rest of the nation. Debt to GDP and unemployment rates both come in below national averages, which can be attributed to the city's economic diversification, international prominence, and its stable tourism sector. Now, with Spanish consumer confidence rising to pre-2007 levels, the city is poised to take advantage of this. One thing that we have to consider is that REI just raised their second fund, which the question that now needs to be asked is where should they invest this capital? Their first fund was centered around investments in the UK and Germany, but these markets have become frothy. Spain, on the other hand, sees GDP growth and household consumption growing at both higher than national averages and higher than both Germany and the UK. This will be strong for the retail sector as demand will go up, which will increase rents and bolster exit proceeds. For a fund that is accustomed to outsized returns, the potential of the Spanish market, coupled with the saturation of the German and UK markets, makes Spain the much better opportunity. Finally, just to go over, the demographics of Madrid are primarily young, relatively wealthy, and professional workers. Now, this is very consistent with the largest consumer demographic of Zara's apparel, which is a great sign for our ultimate recommendation. Now, having given an economic backdrop, I'll give it to Carol, who will do an overview of the retail sector.
Thank you, AJ. Now I'm going to talk about Spain's retail industry. Due to the economic growth in Spain, the retail sector has also performed exceptionally well over the past few years. As you can see on the first graph, Spain's retail sales growth has increased from negative 8% in 2012 to positive 4% in 2015. And we believe that retail sales growth in Spain will continue to be strong in the future. Regarding the disruption of e-commerce, there's no doubt that e-commerce is disrupting and transforming the ways in which retailers conduct business. However, in Spain, online sales only constitute around 4% of total sales in 2011. And as you can see in this graph, Spain has the lowest online retail sales compared to comparable cities like Berlin and London. It is also interesting to note that Spain has the highest retail spending as a percentage of private consumption in 2015. So as consumer confidence levels increase across the board, we could also expect retail spending to increase by the largest proportional share in Spain. Currently, Madrid's low rents and ascending market rent cycle position makes it a very attractive market for both retailers and investors. According to JLL's Cross-Border Retailer Attractiveness Index in 2015, Madrid currently ranks number 5, which is among the most attractive retailer locations in the Wharton comfort cities like London and Berlin. According to Colliers, Madrid's prime shopping center yields is also the highest at around 5.5%, and this suggests that retail properties are priced most attractively in Madrid. Moving on, as you can see, in this chart of prime retail rental clock published by JLL in Q2 of 2015, you can also see that while Berlin and London's rents are decelerating, Madrid's rents are accelerating. So given where Madrid is at the current rent market cycle, we believe that Madrid offers the most attractive opportunity compared to both London and Berlin. And now that I talked about Madrid's retail landscape, I'm going to pass it on to Catherine to talk about the retail corridor.
Thanks, Carol. Calle Fuencarral is an up-and-coming street that offers the best of both worlds. It's recently been designated as high street, yet has discounted rents compared to other high street locations. Its tenant mix is diverse, with a mix of local retailers like Gillesco and also international ones like Michael Kors. The space, 2,400 square meters, is only one of 2 above 1,000 square meters out of 111 spaces in the street, making it a very prominent location. It also has great historical value, as it formerly was a market, as Tommy mentioned. Zooming out a bit, it's a great location. It has 2 prominent metro stops within a 3 to 5 minute walk, and the picturesque Gran Via is a short walk away as well. LREI has been in contact with 3 potential tenants: Spanish-based fast fashion retailer Zara, French sportswear and apparel retailer Decathlon, and UK-based Topshop. Zara, our first choice, is very familiar with the market, offers a corporate guarantee, and has seen steady yet robust growth recently. Although Decathlon also offers a corporate guarantee and slightly higher rents than Zara, its store formats are largely outlet spaces that are very rural, and we don't think this is truly the highest and best use of the space. This would be like taking a Dick's Sporting Goods and placing it in a historic, iconic space in Soho. We also recognize that Decathlon is, however, a financially viable option. Remaining as Topshop, there's no corporate guarantee, a very low presence in the market, and it's had a focus on the US this year, so it's our bottom choice for sure. We also are cognizant that if these options don't work out, we need to have alternatives. The leasing depth chart provides a variety of tenants in different areas, as well as a food hall that we'd potentially pursue. Zara has seen tremendous growth recently. In 2014, it had 94 net store openings and almost $11.6 billion in revenue. Corroborating the retailer's steady yet robust growth is the Moody's rating for its company, its parent company, Inditex. It's one very low risk, and this is essential in this recovering economy. It's a very safe bet. Also notable, Decathlon and Topshop are not public companies. Their credit ratings aren't available. They could be much riskier, especially with Topshop not entering the market. However, because Decathlon has the corporate guarantee, we are aware that the retailer is confident. And lastly, Zara's marketing budget is far under those of other retailers. It's only 0.3% compared to 3 to 5% of revenue. This means that their stores are their billboards. They want to be in a very prominent historical location like this. And lastly, just looking at the physical layout of the space, aesthetically, it fits in perfectly. For example, this prototype in Rome would easily translate to the MDF space. Also, Zara takes full use of this space from the basement up. This is essential in this case. We recognize that Zara's rents are significantly under market and TI concession packages are generous. However, this is largely due to the large store space and Zara's high negotiating power, as it is still one of the top retailers in the country. Ultimately, stores are cognizant of their total spend, and Zara offers the best downside protection. We are confident that with Zara's longer lease term, great credit, and corporate guarantee, that we could regain some of this value back upon sale. Now that I've discussed some of the qualitative drivers behind our projected leases, I'll pass it to Elena to go over the financial analysis.
Thank you, Catherine. So now that Catherine's gone through the qualitative reasoning behind our decision, I'll walk through our underwriting and our financial analysis. So this underwriting is based on Zara occupying the space. I'd also like to note that the underwriting, cash flows, and sensitivities are available at the end of the presentation for both of the other tenants as well. So first I'll start with our assumptions and our sources and uses. We very conservatively underwrote this investment opportunity, adding a CapEx reserve, a management fee, and closing costs, none of which were required by the case, but we added for the sake of conservatism. We also underwrote a 6-month build-out period over which the TI costs are spread out. Zara then begins its lease 6 months into ownership. From then on, it has its 12-month abatement period and starts paying rent 18 months into ownership. We underwrote a 3-year hold period and a 4% exit cap rate. The language in the case implied that a cap rate between 3% and 7% for the stores in this region would be reasonable, and given Zara's high credit rating, corporate guarantee, and long lease term, we thought that it would definitely be on the lower end of that spectrum. The next decision that we made was the leverage. We used the debt fund loan on this deal, given the fact that it offers greater flexibility. Even though the cost of debt is higher at a 5% fixed interest rate as compared to the CMBS loan, which is at a 3.5% fixed interest rate, the prepayment penalty on the CMBS loan, which is yield maintenance, can be extremely punitive and dilutive to returns, especially if you were to sell the asset earlier in the hold period. Next, we see our underwritten cash flows, starting with the 20 million euro investment and the 1.4 million in TI build-out during the first 6 months of ownership. Then you see in year 3 that the forward year 4 NOI is capped at a 4% exit, or at a 4% exit cap rate to lead to 36 million euros in net sales proceeds. Then you see our leveraged cash flows, as well as our unlevered and levered returns. This base case proves to be very, very valuable to LREI. Next, we turn to our sensitivity analysis. As you can see, this deal appears to be very attractive to LREI. The fund as a whole typically uses a 20% leveraged IRR cutoff, and we believe that that should be used here as well, given the lease-up risk and the necessary upfront capital. As you can see, this asset could undergo 100 basis points of cap rate expansion, and as long as it's still sold in year 3 or year 4, it continues to generate those 20% leverage returns. In the bottom chart, you can see as well the effect of the exit cap rate and the hold period on the levered multiple on invested capital and the gross profit. We also underwrote several upside and a downside case. The upside case, which we still believe to be very reasonable, is exiting after 2 years and at a 3% cap rate. This seems reasonable because we are targeting an institutional investor as the next buyer, and they would like to maximize the number of remaining years left on the lease term. And selling at a 3% cap rate again, given Zara's credit and long-term remaining lease, seems very reasonable and generates tremendous returns to LREI. The downside case we underwrote is a 5% exit cap and a 5-year hold. And it's important to note that this still represents a full return of capital and a 1.5 levered multiple. Additionally, we do not believe that both of these situations are going to happen concurrently. For example, if we had to sell at a 5-year exit cap, it would likely be in earlier years, which does still generate that 20% levered return the firm is targeting. So now that I've talked about the financial feasibility of the deal, which proves to be very attractive, I'm going to pass it off to Lizzie for some final concerns and recommendations.
Thanks, Elena. So there are several key risks that LREI should be cognizant of if they decide to move forward with this transaction, primarily new market entrants, geopolitical, forex, e-commerce, and disposition. Starting first with the fund level consideration, this is the first time that LREI will be investing in Madrid and Spain. LREI can mitigate this risk by finding a local partner that's Madrid-based and has retail experience. It's also important to consider that regardless of this, the total equity check regardless investment is 6.4 million upfront with another 3 million euros for concessions and TIs. And together, this equity check equates to roughly 1.1% of deployable capital in Fund 2, so it's unlikely that this transaction will move the needle in aggregate fund performance meaningfully either way. Looking next at geopolitical risk, terror attacks have been on the rise in Europe leading up to 2015, and it is possible that if an attack were to occur in Madrid or in Spain, it could hinder tourism and thus retail sales. With that being said, looking at the graph on the left, tourism in Madrid has been on the rise at a 9.6% compound annual growth rate for the past 3 years, and is forecasted to continue to do so. With that being said, as Lena mentioned, we have included a conservative CapEx reserve that could be used towards installing new security features into the asset as well. And Zara, as well as the Decathlon, have provided a corporate guarantee on the rental payments regardless of store performance. Looking next at foreign exchange risks, LREI is a London-based firm and thus operates presumably in GBP, and this is a euro-denominated transaction. With that being said, the fund itself is euro-denominated, as well as the financing that would be used to purchase the asset, so this should buffer any short-term fluctuations in the currencies. Also, e-commerce is, of course, on the rise at this time and is increasing in popularity, and it's possible that it could corrode the value of the asset at sale. With that being said, sitting in 2015, this is not something we're very concerned about because Spain's e-commerce market is relatively underdeveloped, actually very underdeveloped compared to that of its European peers, and particularly Germany and the UK, as it accounts for only 3.5% of total retail sales. Last but not least, disposition risk, something that any investor should be aware of. With that being said, we feel it's strongly mitigated by two main facts. The first being that there's been an increased amount of retail investment in Madrid and increased market liquidity, suggesting that there should be a deep buyer pool for this asset when we do take it to market. Further, Zara and Inditex's high credit rating coupled with their long-term lease should prove to be very valuable to an institutional investor. In summation, we believe that LREI should move forward with the acquisition of MDF and pursue Zara as a first-choice tenant with Decathlon as a backup choice. We believe Zara is the first choice due to its strong credit, long lease term, great mix with the surrounding tenant base, and mark-to-market opportunity for the next buyer. We believe that LREI should finance the transaction with a 70% LTV loan from the debt fund. With this being said, we believe overall this is a really strong corner retail asset located in a promising retail corridor in an area experiencing strong economic growth, and that it provides a great opportunity for LREI's first Spanish investment. Thank you. We now open the floor for questions.
Wow. That was fantastic. Very good.
Thank you.
I did the mic drop myself.
With respect to the different profile of potential retail tenants, how did you think that would impact the difference in yield for, if someone would pay 4% for Zara, what would they pay for Decathlon?
So we underwrote a 5% exit cap rate for Decathlon as a base case for several reasons. One being the not as optimal mix with the existing tenants on Calle Fuencarral. In addition, the credit is largely unknown. This is something that we would have to dig in more and perform better due diligence on the credit of Decathlon itself in order to really gauge what their credit is like and how much their guarantee means. But yes, to answer your question, 4% was underwritten for Zara, slightly higher for Decathlon, and higher still for Topshop. And we can see in the appendix, I have cash flows, or we underwrote cash flows and sensitivities. This is Zara with the CMBS loan. We have Decathlon underwriting here. So the base case is also a 3-year hold with a 5% exit cap rate. And it generates similar returns at these levels. It does seem like there's more upside, but we believe that Zara had better downside protection.
Did you look into Zara's credit?
Yes, so what we were able to find was that Moody's rated them a 1 out of 10 in terms of risk, making them the least risky as possible.
Did it concern you that Zara was all over the other different markets in that area?
Yeah, so we actually thought this would be a prime opportunity for Zara to expand. It is in the market, it's comfortable there. However, this is an emerging location at a great price compared to other high street retail, so we actually saw that as a benefit.
How big were their footprints in the other markets?
Zara was quite populated in Spain. We didn't find the exact number of stores in 2014. However, they have at least 30 in the Madrid market right now.
This is a 2,400 square meter store. How big were the other stores? It's pretty big for a retailer.
Yeah, so this would be definitely a flagship store for Zara, as well as any other retailer we'd place in there, except Decathlon, it would actually be smaller for them. So this would definitely be larger than Zara's other stores in the area, for the most part.
I think it's also important to mention that, as Catherine did cover briefly in the presentation, Zara has a much lower advertising budget than that of most major retailers because they view their stores as their only real advertising way or their only real means of advertising. So their number of storefronts is much more important to them and more populous than perhaps other retailers.
In addition, Zara's business model follows a highly specialized inventory plan where each store does have different inventory from the surrounding stores, even if they're all in Madrid. And so the competition and cannibalization point is muted here.
And you did not include the initial investment in your IRR calculations at all? Or did you?
We did.
Yeah.
Oh, you did?
Yeah, we did.
You have the 20 million euros up front.
Did you think of going unlevered just to write a bigger check and?
Yeah, that was it.
Yeah.
It was definitely, especially if LREI felt that the risk here was high, the deal was still feasible at an unlevered basis and would reduce the risk and thus would reduce that IRR threshold. However, IRR proved to be accretive on IRR and multiple invested capital, and we felt that the debt was flexible enough, especially with the debt fund, that this was something worth pursuing.
What's the better way to analyze it, unlevered returns or levered returns?
we thought that pursuing it levered, looking at it on a levered basis shows the true returns of the deal itself, and adding that leverage, which does add a certain degree of risk, boosts returns. And so we chose to look at it both ways, which is why we show in this sensitivity up top, we show unlevered and levered. And we think, even at the worst case scenario, at a 6 exit cap and a 6-year hold, you're still generating a 7% unlevered return. It's not terrible, but it's definitely not enough to cover that risk you take up front.
I think we also showed both unlevered and levered returns because we weren't sure exactly what Frank Lampard's risk appetite was. We thought showing both would be the best choice to bring to an investment committee.
Well, I wonder why you're selling in year 3 if you can hold longer and just make more money. You can see here, although I think you can see here that your net profit increases as you hold it longer, although I think there might be an issue with the multiple in year 5
The issue
versus year 4.
Yeah, I can explain that issue.
Oh, okay.
The multiple drops from year 4 to year 5 because the maximum length on the debt fund loan is 4 years. And so you have to pay off the debt in year 4 no matter what, which does reduce that multiple.
Or you could refinance.
Or you could refinance.
But as you think about holding longer, that aside, in order to just collect more cash flow, collect more absolute, I would say dollars, more euros, and return those to your fund investors? Or were you more focused on just a quicker turnaround, a quick win?
We think based on the language in the case, the goal was definitely to flip it as fast as possible, and that would of course maximize IRR as opposed to these net profits. Additionally, since it is a small equity investment, maximizing those profits, we think it's the difference between 16 million euros and 21 million euros on an 850 million euro fund. That's less important, and being able to liquidate that investment quickly, we thought would be more valuable.
And we thought we saw into just institutional investor who would probably prefer to have a long cash flow from the building and lease itself. Selling it early will be easier to sell.
More term.
Mm-hmm.
So a couple of thoughts. Did you see any leasing comps in this sub-market and the overall market? This is a larger store, and that stuff matters with respect to liquidity for the asset and the cap rate you're likely to achieve. Because if your rent's above market or below market, that could influence the cap rate someone's willing to pay. Any comment on that?
Yes, we definitely assessed the leases that were happening nearby, and most of them were on much smaller spaces. And we thought, especially Zara is definitely below market on the ground floor, especially. The ground floor rent of similar tenants and leases happening nearby was around 1,900 euros per year, and Zara is paying less than 600 euros per year. However, on the whole space, this represents a pretty sizable expense for Zara, and so it's important to take that into account. Like Lizzie mentioned in the last slide, that mark-to-market opportunity for the next buyer is definitely something to consider since Zara is paying so far below market, as well as Decathlon. And so both of those were taken into account as well.
Did you attempt the statement that Zara is so far below market essentially compares, I think, in many cases, rents for all ground floor space or predominantly ground floor space to space that's only a third at grade?
Mm.
Did you look at trying to back into what the effective grade rent would be if you discounted above and below grade?
Yeah, we did sort of back into that. And if we used, the kind of market rent on this ground floor space, we were also provided with lease comps that had basement space as well. And that rent per square foot was, or per square meter, was 500 euros per year per square meter. And so if you kind of back that out of the Zara lease, it's paying effectively negative rent on that top floor. So it's definitely, something to consider that it is very far below market. But it's, on the entire space, we think it does make more sense.
And I guess I would compliment you for having thought about the lease depth of the market. Maybe the data available wasn't that great, but thinking about the backup plan, thinking about what other large format tenants were available, thinking about the possibility that none of these 3 leases might work out. Very, very, very strong piece of the analysis. I guess the thing that you didn't necessarily directly mention, but is worth thinking about, is that the Topshop lease, even though it wasn't guaranteed, space, presumably assuming that the lease was guaranteed, but Topshop's not a great credit. So one would have to look at your exit multiple and think about, or your exit value, and think about, well, gee, if somebody else thought this space with a weak credit was worth $57 million, are we leaving something on the table?
Yeah, I think the language implied in the case was that that buyer didn't know at the time whether or not the lease was guaranteed. And our interpretation was that once they found out the lease wasn't guaranteed, it was going to be worth less to them. That was just the way that we interpreted the language in the case, but it was definitely, taken into account.
Just to add, that's also why we included some other tenant options. If their terms were more favorable, we'd definitely be open to other negotiations.
I think also just one more general comment. We realized in the first round, we took an approach, generally speaking, to the whole case of protecting our downside, since this was LREI's first investment in Spain. We do realize that perhaps we could have moved farther out on the risk spectrum, especially given LREI has already left a $5 million hard deposit on the table. So obviously he has maybe a little more appetite for risk. But we were just really focused on making sure this was a really solid first investment in a new market for them.
But it's only 1% of the fund.
Also true.
Very true.
Okay, that's 10 minutes question. Thank you very much.
Thank you.